Gold just did something that forces the dollar to answer. And the next 24 to 72 hours is where this hedge trade either reprices in a clean, brutal step, or it gets smothered by structure before it can run. Not because of vibes, not because of fear. Because the math of protection is changing in real time, and most people are staring at the wrong screen. And later in this video, I am going to give you the exact checklist that decides which path we agree on, the level that flips the whole setup, and the one signal that tells you if this is a controlled repricing or the start of a squeeze. Nobody can politely unwind. Here's the raw context, no poetry. Gold is printing fresh record territory around the high 4,600s per ounce, after starting January down in the low 4,300s, and climbing in a series of sharp pushes. At the same time, the dollar index has been hanging around the high 90s and getting yanked around by risk headlines and rate expectations. That pairing, gold ripping while the dollar doesn't collapse, is the tell. Because that's not the old script. That's not dollar down, gold up, end of story. That's the market saying, I'm not buying protection because the dollar is weak. I'm buying protection because the world is getting more expensive to insure. And that's where the real pressure starts. Because the loud narrative right now is trying to keep this simple. You've heard it. It's just geopolitics. It's just tariffs. It's just a flight to safety that will fade. And sure, the headlines matter. When tariff threats and trade war language hit the tape, when policy credibility gets questioned, when people start gaming out retaliation, growth shocks, supply chain frictions, gold is going to react. But that's not the part that matters. The part that matters is what those headlines do to positioning, to hedging costs, and to the plumbing of price discovery. That's the layer where the real money moves, because that's the layer where people get forced. And if you understand the forced flows, you stop getting emotionally whipsawed by the noise. Let me give you the hidden detail up front, because it reframes everything. This isn't a gold versus dollar story. It's a hedging cost versus credibility story. When investors, especially big global pools of capital, decide they want protection, they have choices. They can hold dollars, they can buy treasuries, they can buy volatility, they can buy gold, they can buy a basket. What determines the mix isn't just fear, it's the cost of carrying each hedge, the liquidity profile, and the scenario set they're trying to protect against. When the cost to hedge currency exposure rises, or when confidence in policy response gets less stable, gold doesn't need the dollar to fall. Gold just needs the insurance premium of the system to rise. And right now, the insurance premium is rising. But that's not the only mechanism, because the next detail is what flips the whole setup. Gold is a global auction, but it's priced through a market structure that can temporarily lie to you. Spot looks like a single number. Futures look like a clean curve. But under the surface, there's a constant negotiation between paper exposure and deliverable reality. If you want exposure, you can buy paper. If you want metal, you need deliverable supply. Those are not the same thing in stressed windows. And when the market gets even slightly tight at the front end, the symptoms show up in spreads, in roll behavior, in delivery incentives, and in the way participants are forced to hedge. So when someone tells you gold is up because people are scared, the right response isn't to argue. The right response is, what is the curve doing? What is the front end doing? What are dealers doing? And what are the big hedgers being forced to do this week? Because if this one level breaks, the math changes. Now let's talk about the chart, but in a way that doesn't insult your intelligence. When an asset pushes into record highs, the resistance isn't a single line anymore. It's a zone of psychology plus positioning. Psychology says, that's expensive. Positioning says, I'm underweight, I need to chase, or I'm short, I need to manage, or I'm long, I need to protect. In record territory, the normal dip buying rhythm changes because the penalty for being wrong gets asymmetric. If you're short and it keeps going, your loss grows faster than your ability to calmly hedge it. If you're long and it snaps back, you get shaken out emotionally and then it rips without you. That's why highs are where bad decisions get manufactured. Here's what matters near term. The round number zone around $4,700 is not just a meme level. It's a behavioral level. It's where a lot of short-term trading logic gets forced to make a choice. Hold above it, and you're telling the market the breakout is real enough to defend. Fail below it, and you're telling the market there's still a cap. And the cap doesn't have to be some cartoon villain. The cap can be as simple as dealers being short gamma near key strikes, or funds being overweight and taking profit into a headline spike, or real yields ticking up and sucking oxygen out of the move. The market doesn't need a conspiracy to stall. It just needs a crowded trade meeting, a mechanical wall. But that wall can also become a trampoline. And that's where the reflexivity engine comes in. If gold grinds upward into areas where options positioning is heavy, dealers who sold calls don't get to disagree, so they hedge. If price rises, their hedge often requires buying the underlying or futures to stay delta neutral. That buying itself can lift price, which requires more hedging, which lifts price again. That's the basic feedback loop people call a gamma squeeze. is not magic. It's a hedging algorithm colliding with a trend. And in thin liquidity, especially after a weekend around policy headlines and into weekly expiries, that loop can accelerate. Not forever, not guaranteed, but enough to create those sharp vertical candles that make retail either FOMO at the top or rage sell the first pullback. And that emotional trap is the product. So what's the dollar doing in this story? Because the title isn't gold only, it's gold and USD, and the key word is hedge trade. Here's the uncomfortable truth. The relationship between gold and the dollar is not a law. It's a tendency that depends on what else is happening. In a clean risk-off, dollar up, gold up can happen, because the dollar is the global funding asset and gold is the global credibility hedge. In an inflation scare, dollar can chop while gold rises because real rates are the real driver. In a growth shock, dollar can spike on liquidity demand while gold holds because the market is not pricing growth, it's pricing policy response. So if you're still trading gold like it's just the inverse of DXY, you're trading a 2013 model in a 2026 market. And right now, the market is acting like it is less interested in strong dollar types and more interested in how expensive is it to be wrong. Here's the mechanism, simplified. Gold competes with real yields. If real yields rise, the opportunity cost of holding gold rises, and gold tends to struggle. If real yields fall, gold tends to breathe. But real yields don't move in a vacuum. They move based on inflation expectations, growth expectations, and the market's belief in central bank reaction functions. When policy credibility gets messy, when inflation risk and growth risk are both in play, real yields can become unstable. That instability is fuel for gold because it makes safe assets less clean as hedges. And when the hedge isn't clean, the hedge basket shifts. But that's not the part that matters. The next part that matters is institutional behavior. When the big money gets nervous, it doesn't announce it. It rotates. It changes collateral preferences. It changes hedge ratios. It changes what it's willing to hold unhedged. It changes what it rolls and when. And those rotations show up in places retail doesn't watch. ETF flows, futures open interest behavior, the slope of the curve, and even how quickly dips get bought relative to the rest of the macro tape. If gold is at record highs and it still doesn't get eyes sold hard like on a dollar bounce, that's a clue. It suggests the bid is structural, not just emotional, and structural bids don't care about your feelings. Now let's bring in the why now trigger, because the title promises 24 to 72 hours, not a 6-month sermon. The calendar matters here in a few ways. First, thin liquidity after weekends is real. The market opens with gaps, spreads can widen, and hedging desks adjust fast. Second, we in a window where weekly options and short-dated hedges force a lot of repositioning in chunks. Third, policy deadlines and tariff timelines compress decision-making. When the tape is full of this starts February 1st style deadlines, participants don't leisurely average in. They hedge before the window because the gap risk is what kills them. And fourth, month-end thinking starts early when volatility rises, because funds don't want to show a big unhedged risk into a reporting window. So over the next 24 to 72 hours, the question is not, will gold go up? The question is, will the market pay up for immediacy? Because paying up for immediacy is the signature of stress. It's the signature of, I need the hedge now, not later. And when that shows up, it changes the entire rhythm. That's the hidden detail again. It's not the spot price. It's the behavior around time. In futures markets, that behavior shows up in contango versus backwardation, in calendar spreads, and in roll yield. In a normal world, a futures curve can be upward sloping, contango, reflecting financing, storage, and convenience yield dynamics. In stress, the front end can get tight, backwardation, where near-dated contracts trade rich relative to later ones because the market values immediate supply and immediate hedge. Now I'm not going to pretend we have perfect real-time visibility into every spread in your head right now. You don't need it. You need the concept. When the front end is stressed, participants get forced to either roll at a cost, source metal, or re-express the hedge via different instruments. All three can support price in ways that look irrational if you were only staring at the headline spot print. And that's where the real pressure starts. Let's also ground the supply side without turning this into a mining documentary. Gold supply doesn't sprint. Mining projects have long lead times. Refining has capacity constraints. Recycling responds, but not instantly, and it's sensitive to price and behavior. When demand shifts quickly, especially for physical allocation, official sector demand, or even just I want exposure that isn't hot someone else, disliability, the supply chain can instantly meet it. The first place you feel that isn't always we ran out of gold. The first place you feel it is in availability, in premiums, in how fast large orders clear, and in the way the front end tightens. It's subtle until it's not. And when it's not subtle, it's already late. Now zoom out globally, because this is where the dollar part becomes more than a symbol. Gold is priced in dollars, yes, but it's demanded globally. If a region faces currency stress, or if local investors view gold as the cleanest hedge against policy risk, their bid matters. Even if the US dollar index is stable, local currencies can be unstable. That creates regional demand that then arbitrages into the global price. The mechanics are simple. If gold is effectively more expensive or cheaper in one region after FX, and the arbitrage route is open, flows and sourcing respond. Not instantly, but enough to keep the global auction honest. That's why sometimes gold feels like it has a mind of its own. It doesn't. It has multiple time zones bidding, each with different stress. So what does this mean for the hedge trade reprices claim? It means this. The market is deciding how it wants to own safety. If the safe asset set is getting questioned because of policy unpredictability, trade friction, growth shocks, or credibility stress, gold becomes a larger slice of the hedge basket. And once that reweighting starts, it doesn't reverse just because a pundit says overbought. It reverses when the underlying cost of hedge or credibility pressure eases, but that's not the part that matters. Here's the part that matters for you, right now in the next few sessions. How do you tell the difference between a controlled pullback that reloads the move and a continuation squeeze that gaps? You watch 4 things: price levels, the dollar's behavior at key inflection points, real yield direction, and rate volatility, and the market's willingness to pay for immediacy through spread behavior and the character of dips. Let's do levels first, because you can't manage risk in a fog. If gold is flirting with the high 4,600s and the psychological $4,700 zone, the market AS first job is to prove it can hold above the breakout area on a retest. A healthy trend doesn't have to go straight up. In fact, straight up is what attracts the most violent pullbacks. A healthy trend often does this. It breaks out, it wobbles, it retests, and then it launches. So the level that matters is not today's high. It's the area where a pullback stops being noise and starts being thesis damage. In this environment, a pullback that holds above the prior breakout zone is often just the market shaking weak hands. A pullback that slices through and can reclaim quickly is the market telling you the bid was more fragile than it looked. Because if that one level breaks, the math changes. Now the dollar. If DXY is in the high 90s, watch how it behaves when risk headlines hit. If the dollar catches a bid and gold refuses to break down, that's bullish for the hedge trade thesis. It says gold demand is not just a dollar weakness trade. It's a credibility and hedging cost trade. If the dollar spikes hard, real spike, not a 0, 2% wiggle, and gold gets hit aggressively and stays heavy, that's a warning that liquidity stress is dominating. Liquidity stress can temporarily hurt everything, even the correct hedge, because margin calls don't care what you believe. They care what you can pay. And that's S where people get wrecked. They confuse whole force liquidation with thesis invalidation, real yields and rate volatility next. You don't need a PhD here. If real yields are rising sharply, it's a headwind. If real yields are falling or unstable, it's a tailwind. More importantly, if rate volatility is high, hedgers seek convexity in clean hedges. Gold can benefit from that uncertainty because it's a hedge that doesn't rely on a single policy path being correct. When the market can confidently price soft landing versus hard landing versus sticky inflation, it diversifies hedges. Gold is one of the few hedges that doesn't require you to be right about which macro story wins. It just requires you to believe the distribution of outcomes got wider, and the distribution feels wider right now. Now the willingness to pay for immediacy. This is the most underwatched thing retail ignores, and it's the one that tells you if the move has teeth. When a market is truly stressed, participants pay up to own near-dated protection. They accept worse rolls, they chase front-month exposure, they buy dips faster, they treat pullbacks as inventory opportunities, not exits. In calm rallies, you see lazy pullbacks and slow recoveries. In stressed repricings, you see shallow pullbacks and aggressive reclaiming. The tape feels like it doesn't want to give you a good entry. That's not your imagination. That's a market in a hurry. And that's where the real pressure starts. Now, I want to address the counterpoints, because if you can't articulate how this fails, you're not doing analysis, you're doing fandom. This can fail through very normal channels. 1, a sharp spike in real yields can cool gold fast. 2, a dollar squeeze can force de-risking across macro books, hitting gold temporarily even if it's the right hedge. 3, if geopolitical or trade headlines de-escalate, some of the urgency premium can bleed out. 4, if positioning gets extremely crowded and liquidity thins further, you can get a violent flush that looks like the end. And 5, if the front-end tightness signals relax, if the market stops paying for immediacy, the bid can fade. Notice what I didn't say. I didn't say it fails because gold is too high. Too high is not a mechanism. Too high is a feeling. Markets punish feelings. So how do you protect yourself from the emotional manipulation that's coming? Because it is coming. In a metal move like this, volatility is not a side effect. It's a weapon. Headlines will flip from record highs to bubble in 12 hours. You'll get a violent red candle and people will tell you the move is over. Then you'll get a violent green candle and people will tell you you're late. This is how the game extracts your attention and your capital. The trick is to separate trend signal from noise. Here's the psychology shield. Define your time frame, define your invalidation, and accept that noise will try to make you betray your plan. If your thesis is about a 24 to 72 hour repricing window, you're not reacting to every 5-minute candle. You're watching whether key levels hold into the close, whether the dollar and yields confirm or contradict, and whether dips get bought with urgency or sold with relief. If your thesis is longer, you still respect that a correct thesis can whip around violently. That's not a disclaimer. That's the nature of leveraged markets and hedged flows. A correct thesis can still hurt you if you size it like a bet, not like a position. And that's where the real pressure starts, sizing and patience. Now let's turn the lens to what comes next in a way that's actually usable. Over the next 24 to 72 hours, you're looking for the market to choose between two scenario paths, and both can happen without warning. Scenario 1 is the controlled pullback and retest. Gold tags or flirts with the $4,700 area, maybe even pokes above, then pulls back as short-term traders take profit and as the dollar tries to stabilize. That pullback holds above a key support zone. Think the prior breakout area in the mid 4,500s to low 4,600s neighborhood. Then it starts reclaiming. The reclaim is the key. If it reclaims quickly and the tape feels like it won't give you time, that's confirmation that the bid is structural. In that scenario, your risk is not being wrong. Your risk is being shaken out by the pullback and watching it run. Scenario 2 is the continuation, squeeze, and gap risk. In this path, gold holds firm, the dollar doesn't get traction, real yields don't spike, and options dynamics plus thin liquidity turn small moves into fast moves. You'll see it in the tape. Shallow pullbacks, strong closes, and sudden bursts higher that don't look healthy, but are very real. In that scenario, your risk is not missing the move. It's chasing at the exact moment the market decides to rip your face off with a snapback. Because squeezes don't end politely. They end with exhaustion and violent mean reversion. Both scenarios can be bullish on a weekly view. They just punish different behaviors. So what confirms the thesis of repricing? 1, gold holding above the breakout zone on a retest. 2, gold staying resilient even if the dollar catches small bids. 3, real yields not surging in a sustained way. 4, dips being bought quickly, especially into the close. 5, any signs, qualitative or structural, that the market is paying up for immediacy rather than happily pushing risk into the future. What weakens the thesis? 1, a clean failure back below the breakout zone that cannot reclaim. 2, a sharp, sustained dollar squeeze paired with rising real yields. 3, a tape that starts selling rallies with relief instead of buying dips with urgency. 4, a sudden calming of the rush behavior where the market stops acting like time matters. And here's the subtle but important CTA, because I'm not begging you for anything. If you're the kind of investor who wants mechanics instead of memes, if you want to understand what forces funds and dealers to move, not just what a headline says, then stay in this lane. Watch the curve behavior, watch the closes, watch the dollar and real yields like they're the steering wheel, not the scenery. And most importantly, don't let volatility bully you into decisions you wouldn't make in a calm room. Because this is exactly how big repricings happen. They happen while people argue about narratives. They happen while the crowd waits for confirmation. They happen when the market decides the cost of insurance is going up and it doesn't ask permission. So here's your 24 to 72 hour playbook in one breath. If gold can hold the breakout zone on a retest, if the dollar can't bully it down, and if real yields don't spike hard, then the hedge trade is still repricing and the path of least resistance stays up, with $4,700 as the psychological battleground and the mid 4,500s to low 4,600s area as the don't break this zone that keeps the trend intact. If we lose that zone and can't reclaim, then the market just told you the move was more headline driven than structural, and you shift from repricing to range and reset. Either way, you don't get hypnotized by the noise. You get paid by respecting the mechanics. And one last pull forward before we close. The market doesn't need everyone to believe in gold for gold to move. It only needs enough participants to be forced to hedge at the same time, in a market where time suddenly matters more than price. That's when the quiet, institutional behavior turns loud. That's when the screen goes vertical. That's when you find out whether this was a spike or a reset of what protection costs in the modern system.